Hi everyone, I'm Kieran Taylor,
I'm Martin Welsh.
and welcome to another episode of Those Pension Guys. So we're kind of following on from what we spoke about last in the budget, but to go into things in a little bit more detail. Martin, what are we talking about today?
So yeah, today is all about inheritance tax on pensions. It was actually in last year's budget, sort of November 2024,
Yeah.
that it was announced that inheritance tax would apply to pensions. And that's the first time in the history of pensions, basically, and
Yeah.
inheritance tax of them being combined. So that's going to affect, I think, a lot more people than they maybe realise.
Yeah.
And that's why I wanted to dedicate a whole podcast to specifically this subject.
Yep. So those pension guys have got your back is basically what you're saying on this.
Absolutely.
I like it. So it's probably a good place for me to start then of what is inheritance tax? So it's kind of in the name that basically it is a tax that is liable to your estate. So basically, what have you got when you die? And before your beneficiaries get the money, what tax is due? Now, some people take of it and think of it more as a personal tax. It's, well, you'll be dead. So technically the
Yeah.
tax isn't on you per se. It is your beneficiaries in the estate. After the tax is paid, that's the bit that goes to the proceeds of your beneficiaries, whoever that may be.
Yeah, that sort of net payout after
Pretty much,
taxes are settled. And I guess looking at, just trying to keep things simple because, you can make this as complicated or as simple as you want, and we
Yeah.
don't want to overcomplicate it unnecessarily. So, looking at the thresholds for inheritance tax, I thought it would be quite useful for our listeners to just explain, this is roughly how it works. This is what it looks like.
Yeah.
So if you're a typical married couple, you've got a £325,000 nil rate band each is how that's looked at. So as a married couple, you got up to £650,000 because if one of them dies, the other one gets the allowance carries over as long as they don't dispose and use their allowance elsewhere.
It's important to say that, isn't it? Yeah. Spouses don't pay inheritance tax.
That's
That's
right.
not the only reason to get married, by the way.
No.
But it's one of the benefits. Yeah.
One benefit, absolutely. So that's the sort of baseline. If you're a married couple, you've got your 650, and that just offsets against any and all your assets within your estate. What was introduced a few years ago is the main resident nil rate band. So that gives each person in that couple an extra £175,000, so 350 collectively, and that can be offset against the main residence. And that was brought in to protect the family home, basically.
Yeah.
So that means that if you've got a family home worth £350,000 or more, you can offset £350,000 as long as you leave it to direct descendants, so children, grandchildren, etc. So it's there to protect the family home. So add all that together, that's £1 million you've got. So as long as your house is of enough value to use the full allowance, you haven't been given any gifts away or anything else, that's a typical allowance. I think today we should just base everything on that £1 million typical couple sort of allowances there. If you are single, it's obviously half that allowance. And quite strangely, actually, we do see this from time to time. If you are in a relationship and unfortunately you lose your spouse, you remarry and you lose that spouse as well, you could actually end up with 3 allowances. Both of your let's pick on the man here. Both of your deceased husbands potentially would go into yours, and you'd have your own one as well. We have seen that occasionally.
Yeah.
But yeah, let's not overcomplicate it. Let's stick to standard couple with £1 million allowance.
And I think that's good, isn't it? Because there's loads of nuances with this and all these kind of things. So let's just try and keep it in examples that people can relate to so they know what we're talking about throughout the podcast. So there's another part to this. Should you be worried about inheritance tax? Well, really, it depends. Now, this sounds like the most obvious thing, but unless you have £1 million or plus in assets, if you've got underneath that, should you worry about inheritance tax? No, probably not. But for some, it's a bit of a worry, and that's where it's good to speak to an accountant or financial advisor, and they can put you in the position to make you aware of these things. Separately, should you worry? Well, technically, no, because with respect, you'll be dead when this tax is paid. And
You won't be here to feel it.
No, it's so amazing. I would say clients always feel different about this, don't they? There's others that feel very principled about it, to think, well, hold on a minute. I've paid income tax, national insurance, dividend tax, capital gains tax, everything my whole life. And then you want to tax me again at the end. No, I'm not happy with that. So people are concerned about it. There's others that think, well, I'll be dead. So it is what it is. I don't need to worry about it. And it's not to say who's right or who's wrong.
No.
It's down to your own personal preference, isn't it?
We see that with clients. We see a real mix there of ones that maybe worry too much about it and it actually doesn't even impact them.
Yeah.
We see ones that don't worry about it, but it impacts them without them realizing it. And then the other ones where actually, who cares? I'm going to live my life, have a great time, and that'll sort itself out then.
Yeah. And you're right, there is no right or wrong answer. It's just down to the individual. So I'll tell you what then, Martin, let's bring it back to inheritance tax on pensions then. So what are the rules today? How does it work today?
Yeah, good question. So in April 2027, that's when it's all approved by HMRC with these changes to go through, and pensions will be included within your estate. But as it stands today, that's not the rules. So if we look at today, keeping the real simple numbers, if we had a typical couple, married relationship, you've got a £400,000 house, you've got £400,000 in your savings, your investments, all other assets, bit of art on the wall, a car, whatever it might be, all your assets, £400,000. So nice and easy, that's £800,000 added together. But imagine this same couple had £800,000 in pensions between them as well. That brings their total to 1.6 million. But the £800,000 pension sits outside the estate right now. So you've got £800,000. You'd go through those bandings that we spoke about at the start, those reliefs, and there'd actually be £0 inheritance tax to be paid on that estate.
Yeah.
When the worst happens, they're both gone. There'd be £0 of inheritance tax to be paid. That's the rules today.
Yeah.
Whereas what they look like in the future,
yeah,
you can enlighten this.
So if we fast forward on to that then, so let's say, for example, then that same couple dies on the 7th of April, 2027, that £800,000 of pension would come into their estate. Now, if you do a little bit of maths on this, after the thresholds and after what they're allowed, £600,000 would be taxed at 40%. That would be the inheritance tax due. You put a number on that, that's £240,000 in tax.
Wow.
That's significant, and that's going to change with the stroke of a pen over a number of days. So this does matter. It is going to be a significant thing. But what changed? Because if you look at the stats today, technically only 1 in 20 estates actually pay inheritance tax. But we know from some of our personal research that number is going to increase massively now, isn't it?
Yeah. We believe, there's going to be a 30% increase in the estates that pay inheritance tax. And that's massive. That's really going to impact a lot. And I remember actually back when I first started out as a financial advisor and some of the training I was doing, and I remember somebody drew a really simple pie chart. So you've got 2 children and you've got HMRC with inheritance tax.
Yeah.
40%, that's the biggest slice, goes to HMRC on the bit above your allowance. And then 30% and 30% go to your 2 children. So, I remember there was almost like a joke when you challenge it of saying, do you like HMRC more than your own children? Do you want them getting the bigger cut than each child? And that's the harsh reality here. Once you've used up your allowances and reliefs, that is what's going to happen.
Yeah. And even for me, I mean, I'm happy to go on record on this and give my own opinion that I am against inheritance tax as a concept. I would say I do follow a similar pursuit to other people, where I think over the course of your life in a country like Britain, you pay tax pretty much from the minute you're born.
Yes.
So there's a hell of a lot you do to pay into the system. Does it feel right to tax again at the end? For me, no. And it is something I'm going to bring into my own financial plan going forward, because it's something I do think about. But it's not that uncommon not to have inheritance tax. I mean, there's countries like Australia, New Zealand, Norway, Austria, countries I would say that we would familiarise ourselves with in the UK and say we have a similar culture and outlook to the world to they do. They don't have an inheritance tax.
Yes.
But listen, the rules are what they are, and they are where they are today. But I suppose help listeners understand this as well, Martin. When it comes to just inheritance tax on the pensions, who pays it? How is it paid? How does it all work?
That's it. Yes, absolutely. Let's stick to just within the pensions of inheritance tax, because of course it can get really complicated quite quickly there. But basically, how most people's estates will work is that there should be a will in place. Let's hope that everyone has that in place. So there's a will in place that appoints your personal representative. So it says, this is who will administer my estates. These will be the responsible people. What we find quite often is that is the kids. I would say, firsthand for me personally, my parents, I know that's the case. But also for a lot of clients, I know that's the case. You pick your son and daughter, or your 2 sons or your 2 daughters, to be your personal representative. So actually, it's their legal responsibility to make sure that inheritance tax is paid.
Yeah.
And this is where it gets really complicated, because let's remember, this is something that's never been in place before, and it's a way to get forced upon us in 2027. So pension providers, it won't surprise you, those pension guys deal with a lot of pension providers.
Yeah.
And there's some really slow, awful ones to deal with out there. Let's just be honest.
We've aged in years significantly having
All
to
that
deal with
grey
some of them,
hair.
but let it go, yeah.
Totally. So, the administration of multiple pensions, so those that have maybe got 5 pensions with 5 different providers, that's putting a lot of pressure now on your personal reps to go get all the valuations up to date as of death, to then find out what's the whole estate worth, where does the pensions play into it, and if it goes over the inheritance tax threshold, each pension is allowed to pay the inheritance directly from the pension scheme, but only for the bit that that ratio relates to on their pension, or their estate, sorry.
So if you say, for example, if you had those 5 pensions, 4 kind of piddly ones that were small areas of service that you had, and 1 massive one, it's not that the bigger one can just take the hit then.
No, so there was some changes in this budget to try and ease some of that administration, but as it stands right now, that's the way it's going to be based on, is each pension can only cover the bit of liability they've caused. So that then has your personal representatives who are going through, the grief of losing somebody,
Yeah.
so it's already a tough enough time for them. Now they're having to speak with pension providers, work out what they're due, try and make sure they pay it within that 6-month window. Let's remember, inheritance tax is supposed to be paid within 6 months to avoid any penalties.
Yeah.
Of course, the personal representatives could team up with a solicitor, and a solicitor could take over and take some of that workload on. At the end of the day, it's the buck stops with the personal representatives. And if it's not paid on time, that's then when penalties start accruing as well there. So in an ideal world, everything would be tied up within 6 months. As soon as you've got multiple pensions with multiple providers,
Yeah.
some of those old workplace schemes that administer themselves that are really slow and clunky to deal with, that's going to be difficult. And another piece, as a top tip, I guess, on this section, it would be remiss not to mention this, is even your beneficiary form.
Yeah.
If your beneficiary form isn't up to date, that's just going to cause even more delays. Of the trustees of that pension will then be wondering, well, who's entitled to this money? Is it the kids? Is it the estate? Where am I paying it? It needs to be approved. Do they need to internally review it? Does it even need to go to court, unfortunately, if there's no beneficiary form? So that's a really important step as well on that piece. So who pays it and how's it paid? It's all down to the personal reps, and the pensions can pay it, but it's a little bit complicated.
So even from an advisor's perspective, though, this just sounds like a ball ache, doesn't it?
It does. So for us poor advisors, it's going to make our lives more complicated and the advice cycle more complicated. But even for pension administrators, that this is something they've never had to do before, worry about estate planning. And now, where's the resource for that coming from?
Yeah.
How are they going to skill up and upskill their team to deal with this as well?
Okay, so it sounds as though, particularly as advisors, we've got to do something to tackle it, don't we?
We do.
So let's maybe bring into that then. What can you do if you're really concerned about IHT on your pension? Now, the first is probably the most obvious of them all. Spend it.
Enjoy it.
You could spend the money. And we've been having these conversations, particularly over the past 12 months, haven't we, with certain clients that are there or around the area they should be worrying about this. And we can say to them, start flying business then.
Yes.
Take the kids and the grandkids to Disneyland. Go and do something. If you just spend that little bit more, you'll be within the thresholds. You'll be fine. And separate, obviously, you'll be able to enjoy the money as well.
Yes.
The other part is that you can gift the money. So it is a case of actually you can decide, or you can realize, and this where working with an advisor can really help. An advisor to sort of help you ascertain, well, actually, I have more asset, I have more wealth than I will need. So actually, I can portion off some of this and gift that away. Now you can do it clean, and you could just say, right, I'm going to gift this money to my kids. There you go. There's some money, reduces my estate, and that's it. Something you have to bear in mind is the 7-year gifting rule. So if you don't survive that gift by 7 years, there could be tax to pay down the line. Equally, there are some people that are a tad uncomfortable with, say, gifting that amount of money right away. They just maybe don't feel it's the right time for their kids to have that money. They maybe feel that they're in a marriage or a relationship where if this breaks down, are they going to lose half this money? There's loads of different things. And what this causes people to do is use a trust and trust planning, where they can gift money into a trust for future beneficiaries. Now, it protects the asset. It works within the same way, however, where, of course, you have to survive the gift by 7 years, but the trust can be designed in a way that can really reflect your wishes and pay out to the beneficiaries as and when you see fit. There are even trusts that still give you access to some of the capital and income, isn't there? There's ones that actually, you are gifting it away, but you still needed some of that money back. You could potentially use that. And I think, depending on the client's situation, that could be really useful, couldn't it?
It is, and I think this is going to get really interesting, at Welsh and Taylor HQ. We've been upskilling, preparing for this. We've been building relations with a couple of local solicitor firms that are really hot on this, and a couple of platforms. Now we're fully independent. We've managed to pick a couple of the leading platforms out there that have got what we believe is the best type of bond and trust products built within them as well. So it's an area that some clients are already talking about, but I think a lot of this is down on the advisors.
Yes.
To really, know your clients, you know the type of clients that you've got, you know what the thresholds are. This needs to be proactive. There's going to be people really suffering here if we don't take the right advice and do this quickly. So
Yeah.
that's a big priority for Welsh and Taylor in 2026, to make sure that we're identifying the clients that are going to be impacted by this. And for the ones that want to take action, we will have a suite of products that
Yeah.
will achieve what they need to achieve.
You're right. It's just not allowing the event to take place and then think, oh, I probably should have started that, say, 7-year clock a few years ago, etc.
Yes.
I guess another thing that's going to change more in the pension world is that I think annuities are going to become more popular again. Because for
Yes.
certain clients, they'll look to think, well, okay, I think I've got enough assets elsewhere to meet my income needs over the next few years. I've got this significant pension that's putting me over the threshold. But if I go to a life insurance provider and they give me a certain quote, if I annuitize, basically, I'm taking my lump sum pension, I'm giving it to a life insurance provider to get a guaranteed income for the rest of their life. Now, the great thing with annuities, most of the time, it dies with you. So people look to think, well, I could reduce my estate and get a secure retirement income. Now, it's not right for everyone because it is a very definitive decision, but I do think for some people, an annuity maybe would make sense. Or, for example, I think a lot of people don't know this. You can do the best of both.
Yes.
If you have quite a significant pension fund, you could look and think, well, I really like flexi access drawdown, and that does work for me, but I could take half my pension and buy an annuity. So you could have half fixed income, half drawdown, and it kind of gives you the best of both worlds. So annuity has been really unpopular over the last 10 years.
Yes.
Might just come back into fashion.
It is really interesting, and it's quite exciting. I won't lie that when things get a bit more complicated, it feels like we're able to add even more value to our clients.
Definitely.
So it allows me, I definitely get a little bit excited to think, well, wait a minute, now, you've got a client with, let's just say, like a £2 million pension. Before it was, let's just grow it really well, take out what you need to spend, live a great life. The family will get it if you don't spend it all. But now, you're really getting into it to say, well, do we do something with, some trust planning? Do we get an annuity to cover all your base expenditure? Then you've got the flexible pension fund. And it's actually quite funny. I was walking the dog, just before the last budget, I remember, and one of the neighbours kind of said, "You guys must love this. It's really confusing. It's really complicated
Yeah.
and scary, and loads of people must be phoning your office wanting advice." And he's kind of right in some ways. It gets frustrating because the goalposts are always changing. We always have to keep
Yeah.
up with legislation. But it's a fair comment to make that the more complicated it gets, the more that we are needed and the more value we can add. And I love that.
So what you're saying is we need to phone Rachel Rees and say, thanks, Rach. You've kept us in a job for another few years anyway.
Maybe not that far.
I think something that's also worth noting that the way HMRC looks at inheritance tax as a whole is if you gift with a warm hand, i.e. meaning when you're alive, that's okay. There's be exceptions and rules for it, that's fine. If you try and gift with a cold hand, basically when you die, that's when tax might be due. So I think that's always something for clients to bear in mind and always something for people to think about. If this matters to you, you have to take action when you're alive.
Yes, and hey, there's going to be listeners out there that the right thing to do is probably to gift some. And I love encouraging clients. If you're in a position that you can do it, warm hand, absolutely do it now. Be there to see them enjoy that money. Take them to Disney, help pay off some of the mortgage. If you firmly believe you will not spend that money, it's just going to cause a bigger problem, more inheritance tax, which is stressing you out and making you not enjoy your retirement. Gift some away if you can afford to. Do it in the right ways, do it for the right reasons, and be there to enjoy those special moments instead of holding on to everything so tightly. And I get it, you've worked hard all your life, you've built it up, you log in, you see a huge value, and you want to keep seeing that go up. You don't want to see a big chunk disappear, but actually you can't take it with you. So the conversations we're having with clients, the positive ones are use it, spend it, enjoy it.
It's a generational shift, isn't it? Because we've seen some great stories recently where people have been able to pay off their kids' mortgages, and they've got a young family, they're struggling, times are tough just now. They can alleviate that burden. They can take the family on a holiday and make memories that they'll never forget. That's something that's so special. So you're right. I think we're starting to see a shift. We're starting to see a change.
We are. And one thing, when speaking about gifting, of course, charity as well. So you can leave charitable donations in your will that actually won't be impacted with that cold hand, if you want to put it that way. So there are clients that are, looking at their will, their estate, and thinking, actually, if I leave over a certain amount, certain percentage to charity, then the inheritance tax bill does reduce down that little bit. So that's really important too. For people that's important too, make sure you get the numbers right so you get the right reliefs out of that as well.
I guess it hits home how money can be such a force for good, and we probably in this world don't talk about that enough. Maybe talk about the negatives, but actually it can be so useful and it can help so many.
Yeah.
So on that note then, give us a chance to close up then, Martin. What would be some of the top tips now if I'm someone that's concerned about inheritance tax and my pension and my funding position, rules are going to change. What should I be doing? What should I be looking out for?
Yeah, so like I said at the start, this is going to impact a lot of people. We've calculated, we believe more than 30% more estates are going to pay inheritance tax. That's huge, almost a third. Increase there. So that's huge. So basically, going back to the start, we said let's base this on the standard couple. Let's be honest, I don't think there's anything standard these days. So it's not just as simple as that.
No.
If you're single and you've got more than 300,000-400,000 in a pension, it's probably going to impact you. If you're a married couple and between the two of you, you've got 700,000-800,000 pounds in a pension,
It's likely,
very likely going to impact you. If you're in the fortunate position where you've got 1, 2, 3, 4 million pounds in a pension, it absolutely is going to impact you massively. So the big thing there is let's work out what you've got. So even if people want to do this on their own, look at your assets, add them all up. It's really silly things. People have got collections of collectible items, and that adds up to £100,000 before you know it. You think, oh, I didn't think that counted. So anything and everything, tot up your whole estate, and just know, right, that's my assets. That's what I'm worth today. But then what are your wishes today? Obviously, things could change, but if you die tomorrow, what are your wishes? If you don't have a will in place, if you don't have that written down, they might not be carried out in what you wanted to be carried out. Or you leave your family with quite a difficult decision to make, that if they don't know your wishes, they'll always wonder if they've done the right thing.
Yeah. I think families that have these conversations about money, I think, are the ones that tend to do better in this. I think sometimes people can be closed books, and it's a case of maybe kids have tried to have that conversation with elderly parents, but they've maybe been a bit more dismissive and, hey, you don't need to worry about that. You'll get what you get when I pass. But I think if you can have that healthy conversation, it does make a difference, doesn't it?
It does make it so much easier. But yeah, absolutely. Make sure your will's up to date, and let's not forget the responsibility that's put on those personal representatives. So you've picked your 20-year-old children, and something unfortunately happened very soon. Is that a fair burden to put on them, that they now have to make sure your inheritance tax is paid on all your pensions at the right time, as well as dealing with the grief of losing, their parents? So that's a big one. Will's up to date. The right personal representatives are chosen. Pension beneficiary forms, that's a big one. So that's something that a lot of people are guilty of, that, you move relationships, if you want to say, you change relationship and your ex-wife is still on that beneficiary form to benefit from that pension. Well, your new wife is going to have a little bit of a fight on their hands to make sure it goes to the right people. Or, you don't have anything filled out. If you've got adopted children or whatever your circumstances might be, it makes life really, really difficult for the pension to even pay out in the first place. So updating beneficiary forms, absolutely important for old pensions, current workplace as well, because it might tie into a death in service plan if you've got that.
Yeah.
So just get your house in order, make your will up, make sure the will's up to date, beneficiary forms. And, it'd be remiss of me, given that we're in the profession, speak to an advisor. Speak to a qualified, independent financial advisor, to really learn where you are, what you could do for the future, and how it's going to impact you.
Definitely. And I think something that I always want to position this right with people, not just clients, but people when I talk to them about this, definitely. Life doesn't have that many guarantees. So many things can change and circumstances will differ in your life. The bad news is all of us walk on planet Earth knowing that one day we will die. That will happen.
Yes.
It's the only certainty that we've got. So do what you can to help the ones, your loved ones, people that you care about, so that when that day comes, you do have your affairs in order, and you know that the way you would have wanted things to pan out absolutely would. And I totally echo your point. I think the advice market's kind of here to save the day on that one, really, isn't it?
We are.
Good. Right, well, thank you, Martin. I really appreciate all your insight there. Thank you for listening as well. This is obviously quite a new and a sensitive topic. So if there's anything in particular you want to talk about, you can get in touch with us via welshandtaylorwealth.co.uk. Thank you, and join us again for another podcast soon.